Please, speak as you might to a young child or a golden retriever.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
The rich get richer, that's the law of the land.
It's just money.
Blasphemy! This is madness!
I drink your milkshake.
Hey everybody, my name is John Kutsmita, and the handsome Barbie-loving man across the screen from me is none other than Brent Johnson, the man behind the dollar milkshake theory. Now, if you don't know what that is, you'll have to learn more on our website at Milkshakes Pod, or go to our video channel at Milkshakes Pod. We've got a ton of organized content there. There's a playlist that says Start Here that will take you down that wild dollar milkshake rabbit hole. But in this episode, which is going to be our weekend full-length edition, we're going to kind of look back on what's been going on in markets and kind of maybe potentially look a little bit ahead. But it was definitely, as promised, a bit of a wild one. Would you say there, Mr. Brent?
Yeah, you know, we talked about it last week that this had the potential to be a market-moving week, and it sort of was. Not huge, but it definitely, you know, the market's kind of topped a couple weeks ago, and they've been a little weak since then. Now, they haven't fallen off a cliff or anything, but you know, we got more information this week. CPI came in a little bit light, but not dramatically light. I think some people were expecting it to be a little lighter than it was. Markets initially jumped on that, but then kind of sold off a little bit. And then today we got some more information on the PPI came in hotter than expected. And then the Michigan sentiment came out and it was a little bit weaker than expected. And so we kind of neutral to hawkish, I would say, data this week. And the reason that's important, and we've talked about this many times, is that the markets have rallied this year based on the expectation that the Fed was either done or largely done. We talked about the Fed raising rates in July, that many people thought that was the last raise. Some people think that maybe we get another raise in September. And the Fed themselves have said they could possibly do two more, but I think the market, for the most part, didn't believe that. And so the market had rallied, but then in the last couple of weeks with the U.S. debt getting downgraded and then a little bit more hawkish data this week, you know, markets are kind of, you know, I don't want to predict a collapse. They're not necessarily going to happen, but they have pulled back from their highs. You know, we talked about it back in June that kind of mid to late June, I finally went net short, and I did it by options. And for the following 6 weeks, you know, that had been wrong, and markets were a little bit higher than that level. But now, I think the Dow's basically at that same level. The S&P is below it, and the Nasdaq's below it. Not by much, but they're now back to that level. So, you know, markets really haven't gone anywhere over the last 2 months, despite they went up and now they've pulled back. And so it's going to be really interesting to see how the next few weeks play out, because we're at this point where people have had a pretty good year that have been in the market, and they're going to start looking at their performance numbers and saying, do I lock this in and you know, either hedge out my exposure, go to cash, or whatever it is. And there's other people who've been trailing all year, and they're probably looking at this pullback and saying, okay, is this my opportunity to get in and maybe make up some ground if the market rebounds? So it'll be really interesting to see where we go from here. I just don't think it's going to be one of these quiet Augusts like we often get.
Yeah, I appreciate that perspective, Brent, on the week that we had. Look, I don't want to throw shade on anybody, especially not someone who's had a significant career in the space. But this week, right before the PPI data, so yesterday, today being the end of the Friday, there was a comment from Mohammed El-Arian. He's one of the big faces, one of the big names back in the day at PIMCO, a huge bond investment firm. You know, it's sometimes interesting when you're looking at these, you know, look at it like rock stars, right? Like, you still go and see some of these bands play 40 years later, 30 years later, and they haven't released an album. So you still kind of hold on to the glory that various people had in that space. I kind of get it in the economic space. But to a certain extent, when I look at the Bill Grosses and the L. Arians, particularly in the bond world, it feels like they kind of rode the gravy train of a, 3-decade bond bull market. And now, it's fun being an editorial writer at Bloomberg. And I thought it was kind of funny for him to come out and make this comment that, based on what Fed funds futures are doing and these indicators we've been looking at almost for 2 years now, predicting not only the end of the world, but at least the end of Fed rate hikes. And he made a comment that, the market or the Fed is finally going to cooperate, with the market, and there's no hike coming in September. Then here we go today, PPI data, and specifically the bond market did not like it at all. So one of the things I think that's mostly appreciated by people who tune into the show and follow you is kind of the grounded nature that you take, and you're not trying to make these like hot take, quick predictions. But are you feeling now, you have said for some time, I think even before the August rate hike, that September was probably on the table. Not that I, have any kind of expertise on the matter per se, but it certainly feels like a September rate hike is looking much more likely than even just yesterday.
Yeah, I've been in the camp that we would get at least one more hike in September for a while, and that the only way we would not get a hike in September was if the markets not only pulled back, but if they went down very, very hard. I mean, there would have to be, in my opinion, a very significant risk-off event prior to September for them not to hike. Although we do get another CPI and PPI print prior to the next Fed meeting. So if those next month were to come in super light, perhaps they would not, but I think that they will. And that's been part of the reason why, even though, we've talked about ways the market could continue to rally, that my base case was that it would not, and that it would pull back. Because I think if the market doesn't pull back, then they're going to keep hiking rates. And, and so one way or the other, I think markets were due for a pullback. Now, so far, the pullback's, 2%, 2.5%, 3%, depending on which market. So, again, let's not get too far ahead of ourselves with a risk-off event here, but we're setting up for one. And the interesting thing for me is, I think I use the word interesting a lot. If I were to go back and look through all our videos, I think interesting would be probably one of the adjectives I use most often. And it's because I'm just fascinated by markets. And there, sometimes you see patterns and sometimes you don't. And a lot of it's just BS, right? People see what they want to see. But I do think it's interesting that the majority of kind of market scares, market crashes, market events, volatility, however you want to define that, they often come in the fall, right? And I'm not sure why that is, but here we are setting up again to have some volatility after extremely low volatility in the first half of the year. We're setting up for some heightened volatility in the second half of the year, and it wouldn't shock me at all if that comes in September, October timeframe.
Well, speaking of market crashes, I'm curious, when you look at the movie The Big Short and the movie Margin Call, do you kind of have a favorite of the two?
Well, I mean, The Big Short's just so good. It's hard to go against The Big Short. And not only that, but I've been fortunate enough, I've met a couple of the guys who were featured in The Big Short, and they're great guys, and they're super smart, and they're super humble. So I'm very biased towards that. Plus, Michael Lewis is like the greatest financial writer, ever. So it's hard to go. But that said, if anybody has not seen the movie Margin Call, I mean, it's fantastic as well. And there's a couple scenes in Margin Call that are just fantastic. We'll have to go over those in detail one time.
Yeah, I think from an entertainment standpoint, Big Short was done much better. The aspect of Margin Call that I like, I think there's certain aspects of it that are much more quotable. I mean, we use a number of the clips in various intros and outros, and but it's more just kind of the bland story behind the chaos. But speaking of that chaos, I think it's kind of interesting to take that, and speaking of word bubbles and using the word interesting, here I go, borrowing your favorite term. But we had, as you mentioned, consumer sentiment, and there's some aspects under this that are kind of maybe stoking the fire here a little bit for future rate hikes. No, so we had buying conditions for durable goods were considered favorable. we had an uptick in durable goods last week. The other thing to keep in mind, and we've talked about a number of times in these conversations, is, you have a Fed funds rate at 5.25, 5.5. Man, if they get to the 6 handle, what is money market funds paying? What are savings account paying? So savers are getting juiced right now to hang tight. They're getting paid to wait. And you've mentioned higher rates ultimately are inflationary to a period of time because people are getting handed, and to some extent, free liquidity. Maybe it's a burden on the government, but the consumer right now maybe is feeling a little cashed up. Now, in the housing market, which is just one of these lurking elephants in the room, everyone's got a hot opinion on housing. Everyone thinks that Airbnb, short-term rental, people getting multiple properties that are investment properties, and that's going to lead to the crash. We haven't really seen any movement in housing prices. The purchase applications index hit a 1995 low. So there's just zero activity. And I mention that because it feels a little bit like, during the COVID lockdowns, we had this huge surge in durable goods, and people were like, well, shoot, I'm in this house. It's time to remodel. It's time to put the addition on. People are almost locked down into their low rate mortgages and aren't moving. I wonder if we're going to see another surge of inflation because of a second durable goods home reinvestment wave that potentially means there's more than just one rate hike on the table in the future.
Yeah, it certainly could. And I'm the first person to say that I am not a real estate expert. It's certainly not a individual home real estate expert. But all the guys I know that are, and, that played The Big Short back in the mid 2000s and made money on it, none of them are bearish housing right now. So, to me, if they saw the same opportunity again, knowing the success they'd already have, I would think that they would be back into that trade. And from what I can tell and from the conversations I've had, they're not. And so I think there is a little bit of the fact that maybe they're not, they're not trading up. They're in the house. They're going to stay there instead of, using whatever cash or whatever they have to go get a bigger house. They're just going to, build up the one that they have. I think where there's a lot more chance for market volatility or a problem is in commercial real estate as opposed to the individual real estate.
Yeah, you had highlighted at least one interesting example around that. Now I'm so subconscious of the word interesting, I'm going to keep saying it. but you shared a tweet that highlighted the apartment building. Was it office or was it a residential?
An office building. Office building.
So huge discounted sale. Was it 66% off of appraised value?
Yeah, it was 60 Spear Street in San Francisco, which is kind of the heart of the financial district. And I think I knew some people that used to actually be in that building. And Credit Suisse was right next door to it when I was in San Francisco, or at least one of the Credit Suisse offices. But it recently sold, and it sold at 66% off assessed value. So, that's a pretty decent haircut, right? And that's important for a couple of reasons, because it sets a precedent, right? We've talked before, like if you have an asset and you just hold on to it for a long time and the accounting rules don't make you market to market, then you can hold that asset for a really long time without it negatively affecting it, as long as you have enough cash coming in to continue operations. Where it starts to be a problem is when your neighbor or somebody across the street or across town does have to sell. And then, something that's comped similar to the asset you own is now at 50% lower than what you're holding it at, right? And that's a big deal. And then the next person has to sell, and all of a sudden, valuations start coming down. And so when people either sell because they want to or sell because they have to, that's when things can get reset. And the reason this is a big problem is I'm not the first to bring this up. This has been out there for a very long time, that there is a lot of dormant or vacant, however you want to describe this, dead commercial real estate. I don't think post-COVID we're ever going to go back to working in the office to the same level that we were before. I do think it'll come back to a certain extent, and there will be exceptions to the norm. But by and large, especially with the rise of technology and the ease with which people can work remotely, I just don't think we're going back to where everybody does the 9 to 5 in an office and everybody has their own office. And so there's just all this extra space that isn't needed. And, the banks, have been able to keep the loans on their balance sheet at par because the companies so far haven't had to leave. But now as things start to get refinanced, right? Leases come up and they got to release them, or loans come due and they got to refinance them, and rates are now 3 times or 2 times or 5 times, whatever it is, higher than they were when those either loans or leases were originally put on. It's going to be a much different thing. So now the payments are much higher. The firms don't need, the companies that have these leases or these loans, they don't need as much space, and they're going to be exiting. And these corporate landlords they're screwed. I mean, that's about the best way to say it, in my opinion. And the problem is they can hold out for a long time, but once their neighbors start selling, which again, this just happened the other day in San Francisco. Now you've got a comp. And so the next person, if anybody was thinking about buying the building next door and paying full price, well, that's been shot to hell, right? So it can have, and here's why it becomes even more important. Not only is it bad for the commercial real estate operators, but it becomes bad for the banks that hold those loans. And what we talked about back in the spring, the big problem they had back in spring was the banks, the small and regional banks. Those were the ones most likely to go bankrupt. And we talked about how we think the trend in community banks is probably going to continue to fall. Well, probably won't surprise people to learn this, but maybe it will, is that most of commercial real estate is held by the small and regional banks as opposed to the big mega banks. Mainly because they know their markets better than some of the bigger commercial banks. So, as we start to get more problems in the commercial real estate industry, we're gonna get back to the banks, where banks start getting in trouble. And as banks start getting in trouble, customers are going to pull their deposits out of there because they're not going to sure if their bank is going to be solvent or not, or if it's going to be safe or not. So then they take their money out of there and they put it in their brokerage account in order to buy treasury bills, or they move it to a big mega bank where they can get, buy treasury bills or something. Because why have your money in a small regional bank that maybe pays you 2 or 3.5% on a money market fund, and it might go bankrupt, when you can put your money in treasury bills and you're going to get it back, right? The government's not going to default on treasury bills. So, all of this stuff is related. And as this is part of the reason why, I've remained kind of steadfast in my view that we're due for some volatility, because this is just another thing that's out there. And the longer you go on, the more likely these kind of landmines are going to start to go off. And once one goes off, it has the potential to cause others to go off.
Well, I think I've got the headline for our thumbnail: landlords are screwed. So, so I appreciate that. Yeah. So I appreciate that soundbite. There's a lot to attack there, and I'm glad you kind of took it in all those various directions, because there's definitely some points to highlight. You talk about this comparable aspect of once one person, has the discount, how it has that domino effect. And I think back to 2009, there's this initial denial, right? You have a foreclosure, and I'm talking the residential market at that time. And You'd say, hey, my house isn't worth that much. That's a foreclosure. And people would try to exclude it from comps as if it was some sort of outlier that wasn't relevant. And they very quickly learn that a comp is a comp. And just because a property sold under distress, it doesn't mean that suddenly that's not how your property is going to be measured, especially when you start to have a inventory of distress assets. And if you're in a position where you need to liquidate or raise capital, it doesn't matter that you're not bankrupt. What matters is the people around you are, and you need a quick sale. There's no arguing with the reality of what, price is indicating. So I think that is a painful reality for commercial real estate, and selling at 66% below assessed value comes with a lot of question marks and a lot of concerns, because assessed value is a tax assessment generally. And
absolutely,
So this kind of tells you where the direction of California's tax receipts are headed. Because how long can assessed value on a tax basis be held 66% above where assets are actually trading? So that, that starts to become a factor as well. And the other thing with commercial real estate is the real market value typically is traded based on net operating incomes. And so those cash flows are completely collapsing. So how would you even, depending on what cap rate you chose, how would you even begin to mark value on an asset where there's no income? And this is where it gets extremely dicey, like you said, for the various banks that are invested in this or hold the CMBS or maybe have a portfolio commercial loan on their books. And that's what's kind of happening here from a distress standpoint. You have these assets, if they aren't selling at some kind of fire sale price, these commercial landlords, so to speak, that are screwed are simply walking away from the asset. And so maybe this is, as you mentioned, a landmine. Maybe there's a ticking time bomb behind it as well.
Yeah, and I think the denial comment that you used is really good because it's not just the landlords who are in denial. It's the banks who are in a little bit denial, or at least pretending that they don't know what's going on. And then, but the governments, right? The city governments, the state governments, the county governments, they're all in a little bit of denial too. Because their tax revenue is based on it, and they certainly don't want to cut spending. They certainly don't want to cut their budget. They certainly don't want their projects not to get funded. But to your point, this is a tax issue because once the commercial real estate, and these are some of the biggest taxpayers, right? It's not just that they're taxpayers; they're some of the biggest taxpayers. And so, when a building gets 66% off, the tax revenue on that is now 66% off, unless they levy new taxes, right? And nobody likes to levy new taxes. And the other part of deniability or denial is that this is a big functions of markets. I mean, this is a hallmark of markets. And I'm reminded of Kyle Bass and Mark Hart. So those are two guys that, they made a killing. They kind of made their name for themselves as extremely successful investors, made a lot of money in the housing meltdown in 2008 and 9. And, they would go around the country and they would go to Seattle and the potential, when they were raising the money for the fund, they would present their case why this was going to be a real estate disaster. And they'd go to Seattle, and the people there in Seattle say, wow, this is a really great idea. It's not going to happen in Seattle for all these reasons, but if the rest of the country, yeah, they're screwed. And then they would go to Denver, and Denver would say, yeah, this is a big problem. It's not going to happen in Denver because da-da-da-da. But, the rest of the country, they're screwed. They'd go to Miami, they'd go to Toronto, they'd go to Dallas, they'd go to New York. Everybody would explain that their country, or their city had these unique advantages that was going to preclude it from participating in this market meltdown. And it basically became the NIMBY argument, right? The not in my backyard. and they, of course, they knew they would come out of these meetings. And I've talked about this, so I know that they'd come out of these meetings and they would just look at each other and they knew, right? Because every city was telling them the same thing. And the reality is once a problem gets big enough, even if you are not one of the quote unquote sinners, and even if you took care of yourself, you are going to be impacted. So anybody who thinks that they have it all figured out, right? They have the magic bullet. They've got gold, they've got Bitcoin, they've got land, they've got whatever it is that they have figured out, they think that they're not going to be impacted. Let me tell you, if this happens, everybody will be impacted. It has the potential to be one of these events where you just can't escape from it. Now, are we going to have another global financial crisis? Listen, I don't know if we are or not. I just know that the markets are set up that if certain things happen, that could happen again. And I think it's important to understand why it could happen and how it could happen.
Yeah, those cascades are definitely important to put a spotlight on, like you just did, especially since we were kind of highlighting California and throughout all of this, banking crisis issue, real estate issue, housing crash is coming, commercial real estate crash is coming. It's easy to beat up on the guy with the black eye in San Francisco, and California has been the punching bag for that. Meanwhile, everyone in the South, whether it's Texas or Florida or some of these other states that have benefited from their better or more attractive tax policies and therefore have seen more migration, have kind of had the narrative or the attitude that they're invincible to these things because look how hot things are here. So careful carrying that chip on your shoulder if something like this does start to spiral out of control, because it could be a tsunami, or thoughts go out to the people in Maui. It could be a wildfire that spreads just as dramatically. So you did have a bit of I don't know if what we would call this a Freudian slip or a DeLorean slip. I don't know what kind of term we come up with, because you were talking about the NIMBY trade. You mentioned Kyle Bass, and you were referencing, this potential for bankruptcy here, but not there. And you had slipped, and instead of saying, hey, not in our state, you said, hey, not in our country, which I thought that was kind of funny, especially when you talk about Kyle Bass, because just recently the two of you kind of had a shared meme switching the BRICS acronym to crabs. Do you want to kind of spell that out a little bit?
Yeah. So, and the first thing I'll say is, I know there's people out there listening to this and say, yeah, Brent, it was a Freudian slip, because you think that the U.S. is not going to be affected when this all goes down. It's not going to happen in my backyard because I'm an American. Well, no, I think it is going to happen in the United States. I think it's going to happen everywhere. It's just that I think that the U.S. will be better off. Doesn't mean we'll be good, but we'll be better off than everybody else. But to your point, the BRICS to the crabs, I gotta be careful how I address this. So, first of all, if I was one of these Americans who had never left the United States and just was, only experiencing the world through the internet or what I read on the internet, that would be one thing. But I have friends all over the world. I have literally traveled all over the world. I've done business on every continent. So I'm not speaking of this from just a random, idea that there are many things that are wrong with the United States. Just because they are wrong here does not mean that Brazil and Russia and India and China and South Africa don't have any issues, and that there's no corruption and everything works efficiently and they're full of geniuses, because they're not. And part of the reason that the U.S. markets have outperformed the rest of the world for so long is because in many ways, the U.S. is more efficient. The U.S. does have advantages that those countries doesn't have. And I feel like there's a little bit of this moral outrage with the United States, with people who criticize the United States, and they feel like it is a moral certainty that the U.S. has to fall. And as a result, they project these incredibly altruistic characteristics on every other country. And it's just not like that. And so the idea that the BRICS are going to come up with this currency, and they're going to do it in secret, and nobody's going to know about it except for that one guy on the internet and Twitter who told you all about it. And they're going to launch this thing, and it's going to work perfectly. And these countries that have been longtime rivals are now going to hug each other and cooperate fully. I mean, you really have to take a leap of faith to believe that. And listen, I'm one of these people who never say never, but to go out and bet an entire portfolio on something like that, in my opinion, is a recipe for disaster. And so the reason we went from BRICS to crabs was because Modi, who's the Prime Minister of India, he initially, there was a report that he wasn't going to go to the meeting in South Africa, and then they said he was going to go, and then maybe he was going to go virtually. But anyway, the point that we made was, or I think I made it, and then he seconded it, was that, well, all they got to do is put Argentina in there, and instead of being the BRICS, you've changed the letters around a little bit, and all of a sudden it's the crabs, right? Which I think is a better name anyway. And again, and just let me be clear, just so I don't get a bunch of hate mail, I'm referring to the countries and the politicians. The people in all these countries are wonderful. So, there you go.
Well, I appreciate the clarity on that and doing it in classic Brent Johnson fashion. I think this is another, speaking of Brent Johnson fashion, another grounded, thoughtful, and broad-based discussion about some important things that are going on and putting them into perspective in an important way as they develop. And we will continue to watch things as they develop. And we are now sharing videos and uploading them multiple times a week. So you'll get updates and plenty more comments from us. The videos have very clear objectives on each one, so it's not just random discussions. We have one coming up in a few days for the Monday Peak of the Week, where we look at the week ahead. We have a midweek update. We now just started our Madness edition, where we discuss some of the craziness that's going on. It should be easy for you to pick and choose what videos you want, or watch all of them. But we've made it organized in a way so you kind of have a sense of how our conversations are going to flow. I always look forward to the weekend ones so we can kind of let some of these discussions run a little long, and they always tend to kind of flow into various connected ideas, which is fun. So I have to thank everybody for the journey. I have to thank you, Brent, and I'm curious, are you sick of me yet?
No, but you're talking about the journey. You're starting to sound like Lagarde. we might have to have a talk offline.
All right. Well, everybody, Brent's going to have a pep talk with me, and we look forward to having a pep talk with all of you in a couple days. So until then, enjoy your weekend and take care. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.